Now, there are many different ways to categorize and separate out different trading strategies, styles, and approaches to trading the financial markets. But pretty much the majority of strategies, they're either based on technical analysis, fundamental analysis, or some sort of hybrid combination of both. Now, in Forex, fundamental analysis is the study of relative economic, social, and political forces that may affect the supply and demand of one country's currency against another. So in the long run, the exchange rate of a currency versus other currencies is usually a direct reflection of the market's opinion on the current and future health of its respective economy compared to other countries' economies. It's also heavily influenced by factors such as central bank actions and interest rates. So obviously, the better the shape a country's economy is, then the more that foreign businesses and foreign investors will come over to invest in that country. And what this results in is the need for those investors to purchase that country's currency in order to be able to obtain those assets. So this increases the demand for that currency and then in turn driving up the price as a result. Now, fundamental traders, they will monitor various factors that impact the relative economic strength of countries, such as interest rates, unemployment numbers, gross domestic product, retail sales, industrial production, and inflation. So to use this kind of analysis effectively, traders must keep an eye on political and economic events, as well as announcements, presentations, and speeches by politicians, economists, and central bankers. And this kind of analysis can take years to master. It can take months for the analysis to play out in the market, and it requires hours of constant research daily. So this is why serious fundamental traders have subscriptions to pretty expensive news and data feeds, such as Bloomberg terminals, which can literally cost thousands, if not tens of thousands of dollars a month. Now, currency exchange rates, they move up and down as a result of supply and demand from market speculators. So every day, investors and traders, both institutional and private sort of retail individuals, they all buy and sell currencies. The numerous types of market participants, they are buying or selling for their own unique reasons, their own unique views, ideas, and beliefs around what the currency pairs they are trading are actually worth. The meeting point of buyers and sellers, for whatever reason they are acting, is price. And no trades can take place unless both the buyer and the seller agree on a price. So it's literally just like an auction, right? And this drives the price of currency pairs. So buyers bring with them demand for the pair, applying upward pressure on prices, and then sellers bring supply for the pair, applying downward pressure on prices. And the market runs like a continuous auction throughout the day, with buyers and sellers constantly competing with each other to get the best possible price. So technical analysis is the framework used to identify trading opportunities through the study of that price movement and volume from that battle between buyers and sellers, and then that is then reflected onto a price chart. So you have these big commercial companies putting huge orders through the market. So let's say there's a big Japanese construction company and they need to buy thousands of tons of timber from Canada. Then they're going to need to exchange a large amount of Japanese yen for Canadian dollars in order to actually make that purchase, right? So they then go and approach the dealing desks at large banks to facilitate that transaction on their behalf. So BFIs, banks and financial institutions, are the other big players who are putting huge orders through the market for loads of different and various reasons. Then there are also speculators who are just purely trading to try and extract a profit from the movement in exchange rates. And this includes both large institutions, large financial institutions, as well as independent retail traders such as us. And all of those above that we just talked about, they are all affected by the forces of human emotion that come into play when sums of money are involved. All of this behavior and participation is what drives the order flow that is put through the market. And the interaction of buyers and sellers with that order flow then prints the price action that we actually see on our charts. And that price action then creates patterns. And these patterns repeat themselves over and over, time and time again. Crowd psychology has been reflected in the price of stocks, indices, commodities, futures, and currencies literally since the beginning of the free market. And the interaction of millions of different participants for as many reasons, all with their own emotions and agendas, that forms price patterns that stretch over extended periods of time and can be used to make high probability forecasts of where price may move in the future. To study that price action on our charts, we want to use something that gives us a little bit more information than just a very simple line chart, which just shows the average price for that time period. Instead, we use something called Japanese candlestick charts, which you can access here at the top of your TradingView toolbar. So Japanese candlestick bar, basically each bar is a candlestick and it represents the price for the time period that you are looking at. So for instance, we are currently on the daily chart. Therefore, each candle very simply represents the price action for that day. So in this case, a grey candle represents an update where price closed higher than which it opened. So for instance, it opened down here, right, where the bar starts, and it closes up here where the actual body of the bar ends. Now, a bearish candle in this case is denoted by the navy, the blue candle. And this is where, very simply, the price closed lower than which it opened. So with this up candle here, right, we opened the day down here, and then we closed up here where the body of the bar finishes there. And then the very next trading session, we then opened where the prior day closed. So the prior day closed here. We then opened at that same price level, and then the day finishes and closes at this price level down here, as if we have that bearish down day. Now the wicks simply just the bottom wick will represent the lowest traded price for that time frame, right? So this is a daily chart, so this means this wick down here, the very bottom of that wick represents the lowest traded price for that day, while the top of the wick indicates the highest price paid. Now, here in Photon, we trade and teach a technical analysis-based strategy. And contrary to popular belief of people outside of the trading industry, you do not need to be aware of fundamentals to consistently make money in the Forex market. All you need is a price chart, and with sound technical analysis skills and a trader's mindset, both of which we teach you how to develop to a professional standard with a detailed step-by-step framework. Now, after you've developed consistency, only if you wish to do so, you can gradually add layer by layer of fundamental analysis to your trading plan if you want to add another dimension to your edge in the market. But in Photon, we focus mainly on technicals, as we have found it gives us maximum clarity in the markets. And our education naturally reflects this in the order of our teaching. The majority of fundamental analysis traders, often referred to as macro traders, they trade on a much longer term horizon, as this is when macroeconomic factors tend to affect price movements on a much longer term scale. Which brings us nicely into the next way that you can define and categorize a trading strategy, which is based on time. So scalping, you've probably heard of that. It's a type of trading where you essentially stay in trades anywhere from just a few seconds to maybe a few minutes, and you're generally targeting a really small movement in price. Then we have day trading, which is where you typically stay in trades anywhere from a few minutes, but generally you don't hold any positions overnight into the next trading day. So of course, as the name states, you're in and out within the day. So your sort of main goal essentially is you're just trying to catch and ride that sort of main price movement of the day, and then you're out. Then we have swing traders, and they stay in trades anywhere from a couple of days up to a few weeks, and they are typically trying to catch a daily trend. And then finally, you have position trading, which is generally where you'll stay in trades anywhere from a couple of weeks to a few months, and sometimes even years. Now, the thing is, you can make money on any time frame. But the important thing is that you need to find what style of trading works best for you, for your lifestyle and your situation, and what is most comfortable for your own unique trading personality and psychology. Now, this is not something that you're just going to know instantly. You might have, a bit of an inclination of what you're most attracted to at the moment, but this is something that you will kind of soon realize with time and experience. Don't worry for now. We'll talk about this in a lot more depth when we start to build out and develop your own personal trading plans. Now, if you take a look at this graph, notice on the y-axis, on the left-hand side of the graph, that it says the number of trades. So that's the number of trading opportunities for each style of trading, which is obviously not the same as the amount of profit that you can necessarily make for each style of trading, right? So if you're scalping, there's probably going to be, maybe even 10 to 50 trading setups in just one day on just one currency pair on its own. But then, all the way to the other end of that scale is if you're position trading, it's unlikely that there will be that many opportunities in an entire year. But more opportunities doesn't necessarily equate to more profit. If you're scalping on the seconds time frame, there's going to be practically an unlimited number of trading setups across the entire market, And if you're trying to look at all of the currency pairs at once on the 15 seconds time frame, there's no way a human can physically execute those, right? So there are three main variables that you can tweak to help reduce the number of trading opportunities down to a much more manageable amount. And that's the number of instruments or currency pairs you trade, the number of markets that you operate within, and the number of setups that you have in your trading plan. If you prefer the shorter time frames, then you may need to accommodate for this by narrowing down the number of currency pairs that you trade and specializing in just a few setups and in just one market, so that you don't spread yourself too thin trying to trade commodities and stocks as well as Forex, for example. And yes, the longer times will give you fewer trading opportunities compared to day trading, for example, but you can also compensate for this by then trading more pairs. You could potentially look at multiple different markets, and you can maybe, as well, add more setups to your arsenal of strategies. So a lot of day traders, they will tend to just pick one or maybe even three pairs that they focus on and really specialize in. Then swing traders, they may look at 10 to 30 pairs, potentially plus a few commodities and stock indices, for example. And then all the way at the other end, where we have the position traders, they will probably look at instruments across all asset classes and taking more of that sort of wider portfolio approach. Now, the majority of us in Photon, and myself included, we take a much more sort of hybrid approach, and we essentially trade all four of those time-based styles, but on just one pair alone, or in some cases, maybe just two or three pairs at an absolute maximum. So you will learn and develop the skill set to be able to enter a position with the accuracy and refinement of a scalper on the lower time frames with a very small stop loss size, but to then hold and target the larger price movements of a swing or even a position trader for insanely huge risk to reward trades. Now, don't get me wrong, this is not easy. I'm not here to sell dreams. This is definitely not something that is going to happen overnight. But you will see throughout this program and your time here at Photon just how truly effective this strategy is. So please be prepared for some limiting beliefs to be absolutely crushed. So when you are beginning the journey with this strategy, I would highly, highly, highly recommend that you just focus on one or two pairs alone so that you can really learn and master your approach on that specific pair. And I promise you will be blown away by the abundance of opportunity that the market will provide to you on a daily basis. It's just down to you to learn how to open yourself up and tap into that opportunity, which is exactly the journey we're going to guide you through over the next 12 months.